John Deere & Company is a worldwide corporation specializing in agriculture, turf, construction, and forestry products and is poised for continued growth in the near future. The firm has shown growth in net sales, revenues, operating profits, and net income in each of the last several years, including record highs in each of these accounts in 2012. By 2018, Deere hopes to reach $50 billion in sales. North America remains Deere's most significant market, accounting for more than 60% of annual sales. But Deere will increase its international efforts by opening 3 factories in China, 2 in Brazil, and 1 in India and Russia. The growing population and shift from rural to urban areas in these emerging economies will spur Deere's growth. In 2010, more than half of the world's population resided in cities for the first time in history. If that trend continues, more than 70% of the population will live in cities by 2050. In that same year, the global population is expected to top 9 billion. Agricultural output will have to double to meet the growing demand for food. The shift from rural to urban areas will create a need for infrastructure development, particularly in developing economies. Deere has shown consistency in its current ratio over the past 3 years, hovering over 2.0. But even with a high current ratio, there is some concern regarding Deere's short-term liquidity since nearly 75% of its current assets are receivables. Although the industry requires longer periods to receive cash payments, this concern is alleviated due to a cash cycle that has been decreasing since 2010. Deere's total debt ratio is on the rise. Out of all assets that Deere has, 87.8% of it is funded by debt. However, it is not uncommon to have a high total debt ratio in capital-intensive industries such as utilities, pipelines, and technology, meaning the debt level that Deere currently has is easily manageable due to stable cash flows. Deere's increasing interest coverage ratio shows that Deere is able to pay interest expenses on its outstanding debt. An increase from 4.73 to 7.035 from 2010 to 2012 shows that Deere's interest debt expense is not a problem and there is a very low risk of defaulting. Deere also has higher return on equity than return on assets. This shows that Deere is using its debt in a positive way and tells stockholders it is correctly handling current borrowing. As for asset utilization, Deere has also proven to be reliable in repaying its suppliers quickly and collecting cash on credit sales. Deere's accounts payable turnover ratio has hovered over the 3.0 mark over the past 3 years, while its account receivable turnover ratio was an industry best 10.19 in 2012, which is nearly twice as much as its 2010 figure of 5.11. As for operating performance, Deere's gross profit margin has decreased in recent years, but its figures are higher than main competitor Caterpillar's. However, where Deere's operating profit margin also decreased from 2011 to 2012, Caterpillar's margin increased. But in the net profit category, Deere experienced a big increase from 2010 to 2011, but then had a setback in 2012. Although Caterpillar had a positive trend of net profit each year between 2010 and 2012, it had lower figures. This suggests Caterpillar spends a significant portion on cost of goods sold, where Deere spends most of its profits on operations. As for return on assets, Deere increased ROA from 2010 to 2011 through a combination of record-breaking sales and an increase in net income. As for return on common equity, Deere saw a significant increase from 2010 to 2011 due to an increase in profit margin for ROCE. This is not surprising since Deere saw record sales and net income in 2011. ROCE increased again between 2011 and 2012, but by a much smaller margin, which can be attributed to a slight decrease in profit margin due to sales increasing by a higher percentage than net income. However, this was offset by an increase in financial leverage. Although Deere appears to be a strong company, it does have its faults as asset utilization can be improved upon. Further, Deere's Altman Z-score of 2.246 is an indicator that it may be at risk of bankruptcy because it is lower than 3. However, because it is higher than 1.8, Deere is not in grave danger. Deere's PE ratio of 11.3 reflects investors' confidence since the stock price and net income have risen each year since 2010. In addition, earnings per share have increased and dividends are projected to increase again in 2013. Furthermore, Deere has been repurchasing common stock in recent years, pointing to management's confidence in Deere's growth potential in coming years. Finally, return on common equity is 44.93%. Thus showing that Deere has the ability to use investment funds to generate earnings growth. In conclusion, as financial analysts, it would be advisable to hold the stock of John Deere.